So anyway, this kind of explains of what happened and how it became. And one of the things that about fraud that is always, it's a little bit interesting to me anyways, the most interesting thing isn't that, you know, the bad people do bad things. That's not really that interesting. But what's interesting is when basically good people, and lots of them, you know, get caught up in these frauds that, you know, they do bad things. One of the biggest frauds in history is, you know, it was actually in Europe, called Parmalat. And anyway, that, you know, when it finally came to light and it came unraveled, they charged 78 auditors with fraud. Not people inside the company, the auditors. They charged 78 of the auditors. Now, people inside the company were also charged, but it's like, okay, you know, I was an auditor. How do you get 78 bad apples in a row to, you know, it's one of those things you just doesn't, you wonder, how does this happen? You know, seriously, how does it happen? And, you know, you like to think, okay, you know, that could never happen to me. I would say, oh, forget it, I'm not doing that. And, you know, the question is, well, how does it happen? How does it happen that 78 auditors, 78, not 7, 78 auditors got wrapped up in this big fraud? And this video, I think, it kind of explains it, you know, and two, one of the reasons why Anthony really wanted to make this video, by the way. And one of the reasons why he wanted to, he said, look, you know, you gotta let people know what it's like. Because you say, okay, don't do bad things, and, you know, that's kind of obvious, and you know, doesn't really make too much sense to people. Why you're saying that? I wouldn't do it anyways. But you know, this kind of explains why. Now, just to give you a little background on this was a graduate class. The actual video of this, he was actually in the class. He was supposed to come for like a half hour, and I think he stayed for 2. I took questions and all kinds of stuff. Anyway, this video has been edited. You'll see it's a little bit jumpy. And every now and then you'll hear a L train come through. But anyway, it's about a half hour long. And it basically kind of, I don't want to say explains, but it helps, I think, to understand what it's like to be in a company that is doing these kinds of things. All right, so what I'm going to do is share my screen. And hopefully, can you guys hear that?
Yeah.
Yes.
Oh, okay.
Sure. I was answering an ad in a newspaper after I graduated from college.
I can't hear it now, though.
I'm sorry, there's a, I was muted. There's a handout that goes along with this. I actually sent out in the email. But let me see if I can, fix the share thing.
Which was a great steady position, corporate level position.
Okay, can you guys hear that?
Around and was responsible for
Yes.
negotiating. At the end of my 16 years there, it was over $1 billion. Sure. That's part of the story. I was answering entered an ad in a newspaper after I graduated from college and started off as low as you can start. They had probably 2,000 stores worldwide at that time, but just a few here in the U.S. They had just started. Started out as an assistant manager, became a manager, a district supervisor. They were growing fast. They needed young, energetic people, and ended up in their purchasing department, which was a great, steady position, corporate level position. Didn't have to move around, and was responsible for negotiating. At the end of my 16 years there, it was over $1 billion of merchandise a year, and I was one of many people there. It was a very large organization, which has only grown since I left. But it was privately held, and that's the key to one of the things I wanted to talk about today. I had my whole corporate experience in a privately held company. One family owned it. It's a company that managed its expenses very wisely, never spent an extra penny on anything they shouldn't be spending a penny on, and they bought product correctly. You could negotiate in good faith with vendors. They knew that what you agreed to verbally was going to happen, and very importantly, at the end of the day, that their invoices were going to be paid on time. If you agreed to pay $1 for a bottle of vegetable oil, that's what you would get paid. You would always get paid on time. Aldi is a company that has operated that way and grown and been incredibly profitable doing that. The business model is very simple. Buy low, sell it at a fair price, hopefully lower than everybody else, and make your thin margin in the middle and grow off of that.
Decided that maybe you would leave there?
That's a very good question. One thing about Aldi is that they are so structured. There's a very clear corporate ladder that you climb. As an assistant manager in a store, you become a manager, then you become a district supervisor of 5 stores, and then you hit this director level. I had progressed through the first 3 up to the director level in about 5 years, which was about normal in those days as they were growing fast. Once I became a director of purchasing, I did that for 12 years, or 11 years, let's say. And the vice president that was over my department was the same age I was. There really wasn't much room for advancement for me at that point. So I could comfortably be a director for the rest of my life, always do the same thing I always did. You know, in my late 30s, thinking if I'm ever going to make a change, you know, that was the time. Got contacted out of the blue by a recruiter for Fleming, and they were serious. And the numbers they talked about were, you know, they asked me what it would take, is what it got down to. So I could negotiate a salary that was very comparable to what I had, and one thing that I had never experienced. I mean, they were a publicly traded company. They offered me these things called stock options, and that was an incentive as well. Fleming stock was trading at about $11 a share at that time, and had good prospects to go up. And you know, here I was, somebody that had worked in a publicly traded environment, very close knit, didn't talk to a lot of other retailers, and there was a real player out there, probably a Fortune 100 company at the time, billions of dollars in sales, easily 4 or 5 times the size of company that Aldi was, and they were serious. They had the right package, and also something that I had never experienced was a bonus. You know, they would match his salary and offer a bonus. I was actually hired away to start a chain of stores very similar to Aldi. Originally, the purchasing office for this new chain of stores was going to be here in the Chicago area, so I got to stay here. When I originally negotiated, it didn't involve a move. I knew it could happen, but they allowed me the freedom to set up the corporate buying office for this little chain of stores anywhere we wanted. And fortunately, one of the executives responsible for this program at Fleming lived in the Chicago area. He wanted to stay also, so we set up an office in Northbrook, and I worked out of that office for a little over a year before it closed. It was a cost-cutting measure to close that and take all of the purchasing into their corporate office in Texas. And it was something that I always knew might happen, and it made sense. Fleming had actually moved its entire company, and this is significant later when you find out why people inside a large organization do what they do. Everybody from Fleming moved from the previous corporate headquarters in Oklahoma City to Louisville, Texas. The whole company moved. They leased a huge warehouse space. It was like an industrial park, and it became the corporate office for Fleming. But everybody working for Fleming in 2001, 2002, until they went bankrupt in 2003, were located in Lewisville, Texas, and nobody was there originally. That's significant when you think of the pressure on people to produce numbers and why there were accounting lapses in the end that led to the downfall. The first meeting I had with Mark Hansen, and talk about why you would make a change, going from a little privately traded company, getting flown on a corporate jet down to have dinner with the CEO, and he's got this vision for a new store. And I asked him how he was going to fund this. I knew Fleming had a lot of debt, over $1 billion in debt, even though they were a large company. I said, how are you going to finance these new stores? He said, well, we've got $450 million in free cash flow. There's plenty of cash out there to open stores. I was very naive. I should have understood that anybody that's dipping into their free cash flow to fund new projects, not the best place to find the money. But there was a lot of money out there, and we did get 17 stores open. And again, they were going along well enough that they thought my services were better used managing all of the private label procurement for Fleming. The reason for that is that they said, well, how are these guys with 17 stores buying a lot of items for a lower cost than what Fleming, this $15 billion wholesaler, is buying for? How can this little group get lower cost than the large group? And it's all comes down to that culture and business practices. I had learned at Aldi that you make your deal, you negotiate for the lowest everyday price you can. There's no funny money involved with that negotiation. Just get down to the lowest everyday cost you can. At Fleming, everything was funny money. You'd have an elevated list cost that you were charged for something. There would be all sorts of allowances that were negotiated below that list cost, and that's where they got in trouble. This gap between what the list cost was and what the true cost was and what it needed to be. It took a lot of energy for the buyers to negotiate that. It was a whole different mindset for them. So they said, look, the guys that are running Yes Less know how to handle private label. We're going to let them be vice presidents of private label for all of Fleming, and they'll buy for the whole wholesaler. So when I went down there, that's what my new position was, as vice president of private label. It was 2 weeks until as I'm sitting in meetings, these guys were not good business people. That gap between a list cost and what you actually pay got exaggerated, and these guys were masters at manipulating that so that a company could report earnings when it bought product instead of when it sold product. And that really is what led to Fleming's downfall. Here's the Wall Street Journal article from September 5th, and this is the last time I'll hand something up. September 5th, 2002. It explains exactly what was going on with the vendors. It's a very accurate article because the main source was another vice president that worked several offices down from me. He left the company. He couldn't stomach it any longer. And he had an axe to grind, and a friend at the Wall Street Journal. And the information's 100% accurate. I have a lot of respect for the Wall Street Journal. It was a front page article, and it was 100% correct. The folks at Fleming and the culture there was that if you needed money to hit your earnings, you could always go back and deduct from the vendors. That was the mindset. Make a deduction. And from an accounting side, we had a controller in our group, and he would always sit there and shake his head and say, no, we can't do this, we can't do this. And somehow at the end of the day, you finally rework the language until it gets done and it gets booked. A few months after I got down there, Fleming signed up their biggest retail group ever. It was Kmart. Fleming supplied them all the groceries and consumables in their stores, which is paper products, health and beauty care, soaps, detergents, things like that. A significant piece of business, about $3.5 billion as I recall. We negotiated for it. Had an internal project that nobody could talk about. They called it Project Blue, which everybody figured out as soon as you said the name from the old blue light specials. But they negotiated for that business, gave Kmart an incredible deal to supply them with all of those grocery products and consumables. My goal in that private label piece was now to make a program work with suppliers that could supply Kmart, could supply Fleming, and could supply the Fleming-owned retail group. All three, and the Fleming private label group. So we had to make everybody happy. Ice cream was a big deal. Ice cream is the largest frozen category. There's more dollar sales in ice cream than anything else in the frozen case at your grocery store. Well, our private label program was a mishmash. We had suppliers in different parts of the country, different labels all over the place. We needed to organize it, go to one supplier who could handle the business everywhere, negotiate the best deal, and make it work for everybody. What happened was Kemp's Marigold had the plant. They have enough plants in different spots in the nation they could supply everybody. They had great quality product, and they had a competitive cost. So we negotiated a deal. They also had incentive money. They had $3 million. They gave Kmart $1 million to make the change. You have to say no to your other suppliers and buy from them. They gave Fleming Retail Group $1 million because now Kemp's/Marigold is the supplier for the Fleming Retail Group. And they gave $1 million to Fleming Corporate for their private label group. So we had $3 million out there. Now what happened was, in the fourth quarter of 2002, our CEO was out there talking to Wall Street saying, here's what our earnings are going to be, 56 cents a share or whatever. That's a rough number. This is what we're going to earn this quarter. And he trots back into his executive suite and gets a handful of guys around him and says, now, look at our plan. What are we really going to earn? And they find it's maybe 20 cents a share. So there's a gap. How do you make up 30 cents a share, you know, in a very short period of time and hit the projection that you've given Wall Street? You know, if you don't hit it, that your stock's going to tank, and the people will lose confidence in your company. You know, your credit can be downgraded. There's all sorts of negative things that happen when you don't hit your numbers. You know, my response was always, well, let's be more careful with the numbers we give everybody. Nobody wanted to hear that. Our CEO was trying to turn this value company into a growth company, and he sent very aggressive numbers to Wall Street. So we had a gap, and what happens is Phil Murphy would come back from that meeting and say, okay, here's our part of what we have to fill. We need $30 million. Our group had to generate $30 million. So he goes, okay, there's about 12 of us in roles comparable to mine. What are all the deals you've got out there? And one of them that I put up on the list was, I said, well, we have this $3 million from Kemp's Marigold. It's a deal we've been working on for almost a year. The money's right here. I mean, it's cash. I mean, the money's there. But the question is, how do you account for that? If that's an incentive for a program that's happening now and in the future, how do you book that as income? And can you? The answer I was told 3 times was no. You can't book it as income. You have to take it as future earnings because it's for a program going forward. So Phil Murphy said, well, call it a rebate. Call it a rebate for business we've done in the past. We did a little business with Kemp's Marigold already. Not everywhere, but we had done some business with them. He said, just call it a rebate and have them sign a paper telling you it's a rebate. I'm like, well, that hasn't come up before. I don't know if that's right to do that. So I talked to the sales guy that I dealt with. Is this something we can do? His CFO got back to him and said, no, we really shouldn't do that. And after going back and forth, Phil Murphy desperately needing that money because he's got to walk back into the CEO and say, we've got you covered. We've got $30 million here that we can book as income and hit your earnings number. And at the end of the day, after going back and forth 3 or 4 times with our CFO, whose name is also on that, who is it? Shapiro? Mark Shapiro? Is he on top there?
Yeah.
Yeah. Mark Shapiro was the chief financial officer. At the end of the day, I couldn't get it done. I said, look, everybody's telling me no. And I went to Phil and said, no, Phil, they're saying it can't be done. The money's there, but we can't book it now. So I'm done. And he said, just tell Shapiro to talk to Marigolds about it. I said, well, okay. I said, they know something I don't find. So I had Mark Shapiro talk to Kemp's Marigold, their chief financial officer. The next thing I know, there's a letter in front of me signed by the CEO of Kemp's Marigold saying that this was some sort of rebate or something. And at the same time, their sales guy signed the agreement, the formal agreement, contract, that they were going to be our private label supplier. So, okay. I guess they knew something I didn't. Again, I was a year and a half, maybe 2 years out of working for a publicly traded company and never had to get involved with anything like that before. We'd always just negotiated and moved forward. And there was never any incentive money associated with any of the deals I had done before, but now there was. And this is the way they did business. I mean, this was normal, and it still goes on today. Super Value is the major wholesaler that does business this way, and CNS Wholesale, there are others. I don't mean, I'm sure most of what they do is above board, but there is potential for danger. I signed that agreement, and we booked that money, and they hit their earnings that year. And the sad part of it is those earnings are also linked to the incentive. I mean, the bonuses that all the executives got were only available if you hit a certain earnings number. So again, more incentive for people in a big organization to do whatever it takes to hit the number.
And your options also.
And options as well, I mean, because it's all linked to the stock price. So the factors that make it so tough, it's really like a boiler room at some point. And really, when Phil Murphy came down, he got the 12 people that controlled all the negotiations and locked us in a room a quarter the size of this one and said, we can't go out till we figure out how we're going to generate $30 million. I shouldn't say he locked it, but clearly if you left the room, you left your job, and after having just relocated your family, and again, everybody in the room had relocated their families to this area because the whole company had moved. And not only that, but when you move, Fleming was very generous with their relocation expenses. They had this executive relocation program. If you couldn't sell your house, this company would buy it for you and then sell it for whatever they could and take the loss. If you leave the company within a certain period of time, you had to reimburse them those relocation expenses. Tens of thousands of dollars that I would have to pay out of my pocket if I left. And the HR person said, how are you perceived as a buying group out there in the world with Procter & Gamble and these other vendors that you deal with, and with some of your contemporaries, your other person groups? How is the Fleming group perceived? And my statement was that we were pirates. I mean, we don't, a lot of fun to hang around, but the guys around me would cut your throat at the end of the day. One of the guys next to me came up with this brilliant idea that, well, there's going to be shared savings now. Now that the vendors don't have to go to Troy, Michigan to call on Kmart and Louisville, Texas to call on us, they're going to save money. We're going to be easier to deal with. The volume's going to be greater. They're going to save money. So they sent out a letter that said, congratulations. You're now selling to and working with this new larger company, larger purchasing organization. It's only going to cost you 3% of your total sales for the year. That's millions and millions of dollars, and hope for the best. We put enormous pressure on them. We did over $1 billion in business with Kraft alone. One of the companies, obviously, that got fined is Kraft. I really feel sorry for the guy named Adams. You can read about him in the article. He was under enormous pressure because of the volume of business that they did with Fleming. Fleming was a very important customer to Kraft, $1 billion in sales. And if it meant signing a letter that $7 million or $10 million would get funneled to Fleming somehow over a couple of years, he signed it. There was still hope. I mean, when Kmart business came on, if everything happened the way the CEO wanted, it could have worked. I mean, look at what Sears did with Kmart. That worked when they just got together and made it work. But for us, it didn't. It just did not work. I could see it going bad. I was tired of being the company was using my credibility that I had worked hard for over 16 years with Aldi and doing clean business. They spent my credibility dealing with vendors now, where I would sit with somebody face to face at a desk and I couldn't tell them that everything was going to be handled. I couldn't tell them that their bills were going to be paid and that those deductions were going to be repaid. My word didn't mean anything to them anymore, and I wouldn't. I would just tell them, I said, look, we're all in trouble. This is not going to work. If you want to get those paid back, I don't think you're going to. What happens then is if they still want to do business, and that's a big if, it'll be at a higher cost. Whatever you're taking from them, they're going to add back to the top line cost because they have to make money at the end of the day. And it's a really vicious cycle that elevates the cost, makes Fleming uncompetitive in the marketplace, and at the end of the day, that $450 million in cash flow that Mark Hansen was so proud of, it went away because these vendors said, we can't handle the deductions anymore, it's not working, we have to put you on cash in advance. And that's a death note for a company. As soon as you start having to pay for product before you receive it, your whole cash flow goes away. One of the yellow flags that went up early for me, when I was running those 17 stores at Yes Less, the invoices went through the Fleming accounting system. They had a computer program that figured out how long they could stretch each vendor. I had no idea, couldn't believe it. And it was really based on feedback. Well, how many days is it before this vendor will call me and ask for his money? Okay, it's due in 30 days, but I haven't paid in 45. When do I get that call from them? And they recorded it. Each time they would record, okay, so this person doesn't care until 45 days. So they would just never pay until 45 days. If you weren't sitting on top of them, things wouldn't get paid. So yeah, they definitely stretched that as far as they could. But you think about that, a $15 billion company, that's $41 million a day in business that you're doing. And that's literally what crushed them in the end. When you can't buy products because you need cash in advance and your customers are clamoring for it, you're out of business. And Fleming literally went out of business because of that.
Yeah, so they could have been profitable.
Absolutely, and they were for many years. I mean, Fleming's was a 100-year-old company that had grown through acquisition and been successful up until that lawsuit with David's, quite frankly. I mean, they hadn't made money for a few years, but when Hansen was there, they reported their first quarterly profit in 4 or 5 years. And yes, they could have made money the right way. But his vision was to not just have a value stock, not just to be one that languished out there and just was kind of safe and comfortable. He wanted growth. He had come from PetSmart, Sam's, fast-growing companies, and as we looked at his history, he kind of did this at those companies too, unfortunately. And he never learned his lesson. I think he's learned it now. I was very surprised. I was surprised that people beyond Jim Thatcher, Al Abood, and Phil Murphy weren't charged. I will say that Al Abood, who was right next to me and another vice president, the whole reason he was there was because he was better at taking that money than anybody I ever met. He actually worked for Kmart, did it there, got in trouble at Kmart too. And I was astonished one day when I came in and he was in the office next to me. I'm like, Al, why are you here? Well, Phil Murphy had hired him. He apparently did such a good job taking money at Kmart that Phil wanted him on our team. And that was another red flag for me to get out of there as quick as I could. Yeah, I wish I would have stood up on the CEO's desk and said, look, this is not right. It's not right what you're doing to your own people, number one, putting me in the position where I have to, again, spend my credibility to try to save face with vendors. And for the vendors who are our partners in business, we can't be in business without them, for sure. We're destroying those relationships, and it's not right. I can give you one specific example. You'll notice one of the companies that got fined there is Kemp's Marigold, a dairy. They got fined, the CEO got fined, their chief financial officer got fined. Personally, they got fined, as well as the company, hundreds of thousands of dollars in fines. That was a deal I did. I was very upset about that. My resignation letter to Phil, I worded it carefully. I was an English major in college before I started working in the grocery business. And one of the things we use when we analyze poetry, we talk about the gap between appearance and reality when somebody wrote a poem. And to me, that's what I saw at Fleming, was this huge gap between the appearance that the CEO put out there and the reality of how the business was run every day. And I told Phil that I could no longer willingly suspend my disbelief in the way the company was being run. And that was true. I said, because you would sit around and look at each other and see the way you're doing business, just shake your head and say, I can't believe this, I can't believe it. And you have to willingly suspend that disbelief to operate in that environment, in that culture. Couldn't do that any longer. It's too obvious. I mean, the facts were too obvious. The business model was not working, at least not the way the CEO was describing it to Wall Street, that we're this big growth vehicle, we're going to be profitable. It was not. We were scraping for every penny. And another startup opportunity in New York became available. Once again, we could set our office, corporate buying office here in Chicago. So we got the team that put the Yes Less stores, several of us back together to open another chain of stores in the Northeast. And I was excited about that. Negotiated a fair salary, no bonuses, no stock options, just it was a private company, it's one guy. The document that none of you ever want to see again and ever want to see your name on is this, it's my subpoena from the SEC to testify. So pass that around and make sure you never see one again. But the bottom line is that it's very easy to testify in front of the SEC. You tell them everything that happened, exactly why it happened, don't leave out any details, and it is what it is. Unfortunately, a lot of my testimony led to huge fines for the guy that worked right next door to me. His name's Alaboud. Here's the SEC exchange, what they charged each of those guys with. But I reported to Phil. Alaboud was a vice president, just like I was. He worked right next to me. If you don't live it and feel it, and you would never know. You can read about it, but it overtakes your whole being at some point when you're right in the middle of all of that, and you see it kind of crashing down. So, like I said, at the end, it can make you stronger, and I certainly learned a lot. They also wanted to know a lot about the CEO. The one thing I'm truly amazed about is that Mark Hansen, the CEO, he hasn't been charged with anything. But it's very difficult, and I have sympathy for the SEC as they go after like the Ken Lays of the world, or Bernie Ebbers from WorldCom, or it's very difficult because these CEOs never send an email. They have assistants and they do everything in meetings, and it's all verbal. It's never taped, but the direction is completely clear. They walk into the meeting, they come out with their marching orders. Each senior person has to contribute a certain amount of money so he can hit the earnings that he's talking to Wall Street about. None of that is in writing, other than the notes that the guys take who were in the meeting. So I had to say, yes, when Phil came out at his meeting with Mark Hansen, this is what he came back to us with, that we need to make $30 million here to hit the number. What you really judge on is what you do and not what you say, which is right in some ways, but for a CEO who never does anything himself, he didn't sign any documents except Sarbanes-Oxley. When Sarbanes-Oxley came out, we were all, and it's an interesting sidelight, we were like, is he going to sign it? Is he going to sign it and say, yes, I believe all this information is 100% accurate? And he did. He did sign it. And I always thought that that would come back to haunt him, to say that to the best of my knowledge, all these numbers are accurate, everything's justified, when he knew in his heart anyway that it wasn't accurate, most of it was manufactured. And it's so interesting, when I used to hear Ken Lay, who would just insist on his innocence, and just think, well, what we did wasn't wrong. Yes, we did all of that. Yes, we created these subsidiaries and put the debt all over there, but that wasn't wrong. It wasn't wrong. It's like they convinced themselves that what they're doing is right. When I listen to some and read some of the quotes that Mark gave to Wall Street, that the deductions that we have with vendors aren't out of line. It's in the Wall Street Journal article. It's not out of line with what the industry standards are. It's a certain percentage of sales. It's always like that with every wholesaler. They convince themselves that what they're doing is right, that it's okay, and that that's just the way of doing business. There's just some sort of a mental illness almost when it comes to that. And the CEOs get it sometimes. It was frightening to watch. But I walked away from big bonuses just doing what I did. Other guys that stayed, even a few months after I was there, I was 2 months away, I think, from like a full year's bonus, which for them, again, was too generous, almost 80% of the salary. I didn't want it. I mean, who would want that? So I wasn't going to stay long. And I would have continued to do what I was supposed to do, which was to put together the best deals for the company that I could. How they were accounted for, I did kind of mentally separate myself from that. I had to. I mean, all I could do is what I knew was right every day. Negotiate for the best quality products at the lowest price. Simple. That's what I'm there for. How you want to account for everything else, I just kind of washed my hands of it and said, take it from there and go. That's kind of the mode I was in right at the time I left, and I would have found something else at some point. that was not sustainable down there. The guy that had worked for Fleming for probably 27 years was a merchandise manager there, and he stayed right till the end. And you know, it was horrible for him and his family, knowing that this 27-year career he had, and probably his retirement, you know, account with the company was all in jeopardy at that point. I mean, his wife actually had some mental problems, and she committed suicide the day they went bankrupt. It was really, really horrible. There are personal tragedies involved when things like this go on. It might have worked. If Fleming had ever purchased Kmart the way Sears just did, you know, maybe their stock would be $100 like Kmart's and Sears is right now. But that didn't happen.
Turn off, stop. Okay. Hey, that's not me. Hello. Okay, so yeah, so going to I think it does Anthony does a pretty good job of kind of explaining, you know, how, you know, people who are basically good, you know, kind of can end up in those kind of situations. And let me see something here. Give me 1 second. Oh, I'll share my screen. Okay, I think most of the stuff is pretty worked for Aldi, then Fleming. Okay, and publicly traded, and this whole thing was kind of it's kind of an amazingly bad case. The whole thing hinged on Mark Hansen, who was the president, of him giving our CEO, of him giving Wall Street a completely crazy forecast. You know, this is a 100-year-old company, a $15 billion company, and it didn't last a year after that forecast. By October of next year, 2003, it was gone. It was bankrupt. You know, that's a 100-year-old company with thousands of employees. One person basically sank it. And Mark Hansen's kind of an interesting character. He worked for PetSmart he came in as a CEO for PetSmart, stopped paying vendors there. PetSmart almost went bankrupt, almost went out of business when he was there. So he was let go after a little more than a year from PetSmart. PetSmart was this really fast growing store, and then all of a sudden, like, their shelves were half empty. So then he goes on and he comes in as, I think, the interim CEO of Sam's Club, and kind of does the same thing. All of a sudden, Sam's Clubs have a bunch of empty shelves because people are no longer shipping because they're not getting paid. So that was his background. But when he came, you know, coming into Fleming, it was, you know, hey, I worked for, you know, PetSmart, they're real big and profitable. Sam's Club, they're big and profitable, even though he'd actually been kind of a disaster at both those places. And he had made millions on those. He made millions on both of those places with those stock options and stuff. You know, because at first the company looks very profitable because they're not paying their bills, but what happens later on is that, you know, they stop getting products into them. Anyway, a very odd era, and very odd person, really. And very odd that he was hired, you know, at the positions that he was hired at. But anyway, Yeah, so a couple things about just in general about it. I think there's a question there that wasn't answered in the video. Let me share my screen here. Fleming was profitable, and that's another weird thing about it, is that there was a profitable company that went bankrupt. This one, why Anthony wasn't charged by the SEC, it's not in the video. Anthony wasn't charged because he luckily he couldn't convince them to sign the rebate letter. If they had signed the rebate letter, he probably would have been fine too. That's how close he came to, basically having charges against him. Was that they had someone said, yeah, we'll sign that rebate letter to him, he'd have been charged. The SEC found through emails that he hadn't got it signed, and that that's why he wasn't. That's why, but he was called in to testify. In case about the other ones. One of the things about this that is that people would ask him later on is they say, did you know the fraud? You were with Fleming. Did you know that there was fraud there? Yeah. And what did you do about it? Nothing. You didn't tell anyone? No. And what you find out is a lot of times people will not say anything about fraud unless you ask them. So as auditors, one of the questions that you ask someone, do you know of any fraud going on between management and the company or the company itself? It's surprising how many times people will just sit there and not say anything. But if you ask them directly, they're not willing to lie. They'll say, yeah. And that's one of the kind of strange things about this whole case. If nobody asks, a lot of times no one will say anything. But at the same time, if you do ask, most people will not, lie if they're directly asked about it. So that's one of those things that to keep in mind when you're doing auditing is that ask. Do you know of any fraud, employees and management or the company itself, and see what you get. One of the things that's kind of funny I left in there, and I leave it in there every time, is the whole thing about the Sears and Kmart, just because it's such a bygone era. When I was in my 20s, Sears was the largest retailer in the world. They were like the Walmart, and Kmart was the biggest discount retailer probably in the world. And Walmart was this really weird Southern ripoff of Kmart. I mean, that was when I was growing up. That was like, you didn't hear about Walmart except you met somebody from down south somewhere and they would talk about it. But nowadays it's like Target and Walmart have, I don't know what percentage of it, but Sears and Kmart was they were the big names when we were all growing up, or when I was growing up. Anyway, any questions on any of this? Okay. Well, so go ahead.
I have some questions. Sorry, I missed some of the video, so I have some blank answers.
Okay.
It's just I think it's about 2 of them or maybe 3 of them. Numbers 3, 4, and 6.
Oh, how are the 3 companies different? All these is private. Is this all these? Something like that. I don't know. Is it privately held? You can't buy their stock. At least you couldn't back then. I don't know if you can now. And Fleming was public. So in our terms, this would be a non-issuer, a very big non-issuer, and this would have been a No, right. And this would have been an issuer. I'm sorry, you said number 3 and which one else? Which one?
Number 3, 4, and you know what? I think I missed 7 as well, but I have 4, 6, and 7. Yeah.
4, 6, and 7. Oh, why did he leave? His boss was the same age he was. In other words, he wasn't going anywhere. He couldn't move up anymore.
It's kind of like a glass ceiling, they say.
Oh wait, you can't see my screen. I'm getting stupid here. Yeah. So two companies different. All these was privately traded. Something was public. His supervisor, same age he was. Yeah. So it wasn't like the supervisor was going to retire or anything, and the supervisor was at a pretty high level that would probably be about the highest level that someone from the United States would have in that company. And so, he wasn't going to go anywhere. So that's why he, and two, it's one of those things that, he was at an age where, okay, if I'm going to go, now's the time to do it. If I wait any longer, it's not going to happen. And so anyway, he was, it was a big opportunity for him, again, he could have, worked at Aldi forever, but he decided to give it a try. What caused the fraud to occur? The CEO, Fleming CEO, so Fleming CEO Mark Hafen gave an inflated earnings estimate to Wall Street. And what do they have to do? And Anthony was asked to get the rebate letter signed. That he didn't do. Thankfully, failed. And here's the weirdest thing. Here's the weirdest thing about it. You think of a company going bankrupt, you think, okay, that they had problems, and then they lost money, and finally they couldn't, go on any longer. That's usually what you think about bankruptcy. Fleming was profitable. They weren't as profitable as they said they were, but it was a profitable company. So here you have this 100-year-old, huge, $15 billion, probably, certainly Fortune 500, but probably Fortune 100 company, the 100 biggest companies in the United States, that was profitable, and it went bankrupt within months of this estimate that was given to Wall Street. We're not talking about like 5 years. We're literally talking about from the time that the vendors started to kind of revolt. It was about maybe 4 months. In 4 months, a $15 billion company with thousands of employees, tens of thousands of employees, a profitable company, again, they weren't as profitable as they said they were, but they were profitable, went bankrupt. And, talk about an odd case. I mean, that's like the definition of it. But anyway, Yeah, so that's, and it's kind of funny because Anthony he's a really by the book kind of straightforward kind of person. You know, he coach little league teams and all that kind of stuff, and squeaky clean. I don't think I've ever heard him swear. I've known him for 30 years, and I don't think I've ever actually heard him swear. So, then that's just the kind of person he is, so it's kind of strange that he would be, you go, okay, of all the people on the planet, he'll never get mixed up in something like this. But, there you go. Okay. So I think what we'll do, let's go ahead and take a break. And then we'll come back and start in on, nope, not that. I think we'll go back to the accounts receivable handout. Okay, so let's say be back in say 10 minutes. Be back at well, let's say 7:10.
Professor, are you there?
Yep. Yeah. I'm not-
What handout is that?
Oh, this is the accounts receivable handout.
Oh,
Temporary-
okay, I was looking for which page that was on.
It's probably not on the right page. It's probably on, I'm on page 2. It might still be on page 1.
Oh, that's interesting. I've got customer purchase orders, not used, sales order, credit approval. What is that?
Yeah, that's it. That's the one.
Oh, okay, so what page is, you're on, that's page 2 or page 3?
I'm on, right underneath where it says aging of accounts.
Okay, gotcha.
So it's, I think we got down to C last time. I was just putting some stuff in here.
Okay.
This up over here. Oh, I know. Okay, one of the things that I want to talk about just briefly before we get into go back to the handout is the use of subsidiary journals. Subsidiary journals are made so that you can it's for a group of transactions that are identical usually, and so that it's quicker to enter them into the sales journal, and actually you can do a better job of it than entering individual journal entries. You know, in accounting 210, we put in the individual journal entries. You know, they sold whatever. They sold a truck, you know, and you put in the journal entry for that. They bought whatever. But the reality is that a lot of times you'll have things like a sales journal. Whenever you make a sale, it goes into the sales journal. And then at the end of the day or month or week or whatever it is, that thing is totaled up and entered into the general ledger all at once. So if you have 15 sales in a day, you don't make 15 journal entries. You enter it 15 times into the sales journal, and then it goes in as one entry. You know, and it'll be the same thing with a purchasing journal. You know, the purchases will go in as one. Accounts receivable journal go in as one entry at the end of the day. So you'll have see subsidiary journals and ledgers of accounts that, again, and they're separated because it's usually for when you have a lot of transactions that are identical. You know, think about Walmart. You know, any given store has thousands of transactions a day. They're not going to make thousands of journal entries for, you know, a day. They're going to get all the sales together, and that's going to go in as one number. So, you know, that's the whole idea behind subsidiary entries or subsidiary journals, is that they usually have everything. So, for instance, if you had, you know, if you're making sales, you made one for that, you made one for that, blah, 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 blah. at some point you go, okay, wait a minute, this, this is a lot of journal entries. Instead, get a list together of all the sales. And, so all the sales from the day will be totaled in this journal entry. And from the sales journal, whatever this whole list is, you'll make one journal entry. Maybe it's, making this number up, but maybe for all the sales for the day were $23,000. So from the sales journal, there's just a list of sales made for the day. They say, okay, this is a list of the sales made for the day. We know that all of them would have this journal entry. So at the end of the day, we make this, our, for everything that comes out of the sales journal. So the sales journal will be a big list, all the transactions that were rung up. It goes in as one journal entry. So the sales journal is really what you're looking at. And again, it could be, every company is different as far as what they have for their journals and all that, and their accounts and everything else. So it depends really how they're set up, but these subsidiary ledgers and journals are really there for transactions that are very common, things like sales, purchases, all that kind of stuff. And then it will enter those all as one and for the day. Now you can still get the detail. You go back to the sales journal, say who you sold it to and what date and time and all that kind of stuff. But the journal entry actually goes in as one. So this journal entry would go into the sales journal, and this would go into the general ledger, the big book of all the journals. Okay. Now, if you have a accounts receivable subsidiary ledger, it's kind of the same thing. Okay, you have all these different things happening for accounts receivable. So it is possible that instead of this one going to, right into the ledger, it looked something like this. That go into the sales journal, that goes into the accounts receivable subsidiary ledger, and that subsidiary ledger will then go into the general ledger. So this account right here would really be not used. It would just go in as from the sales, generally the credit, and then down here you go into the accounts receivable subsidiary ledger, and that would go into the general ledger. Okay, so you'll notice that these two should match, right? Whatever, if this is, let me unmark this. If the accounts receivable, and the sales go hand in hand together in the journal entry, then these two should match. At least for the credit sales, these two should match. So when they talk about this, the sales journal reconciliation with the accounts receivable subsidiary ledger, that's what they're talking about. They're saying, okay, these two, here's the journal entry, and so those two should match. And so we should reconcile these two together, at least for credit sales anyways, that the credit sales should equal the accounts receivable, what's going into the additions to the accounts receivable ledger. Okay. Now you can do this daily. Sometimes they will. Sometimes they'll have it'll be mechanically done or computer generated. But here's just kind of an example. You do not need to write this down. I just threw this in here just for, I don't know, laughs. But this is basically an idea of what we would be talking about. Is that you'd have this accounts receivable subsidiary ledger at the beginning of, say, March and at the end of March. And say, okay, it changed by 180,000. Well, when you do the reconciliation, you should be able to account for that change. And so coming down here, this is total sales. And again, these are just numbers I made up, so don't do what I just did and mess up the spacing. Okay, so you have your total sales. You know, these are all the sales together, but some of those were in cash. So those aren't going to be in accounts receivable. And so here would be the credit sales. Now, if nothing else happened to the accounts, then the accounts receivable should go up by 1.2 million. But some customers paid their accounts. Thank you. And there's also sometimes customer returns. They return some stuff. So these will reduce, you know, the amount that they would be in those accounts receivable. They paid them off, they don't owe us anymore, or they return the stuff, they don't owe us anymore for that. And so this net change down here should be the same as it is up here. So this is, again, you do not need to write this down. But I just want to kind of show you what they're talking about when they say do a reconciliation. That you account for those changes in the account. You know, there's stuff coming in, there's stuff going out, reconciling that, you know, at the end of the period, you know, whatever these credit sales were, minus the cash received for the accounts receivable, minus the stuff they returned, you know, whatever's left over. This could be a negative number. If this was, you know, 900,000, you know, whatever, it could be a negative, it went down. But anyway, that's what they're talking about when they say doing a reconciliation of it. Sometimes they'll do it by the day. Sometimes they'll do it by the month. Most places will do it by the month, you know, if not the day. Again, a lot of times it's all mechanically, you know, or computer generated. You know, this will be one of the reports that spits out. Question on that? So this is the sales journal reconciliation with the accounts receivable ledger. This is what they're kind of talking about. So these are, again, and you get used to using those ledgers. Those ledgers are really there for when you have multiple accounts doing exactly the same thing, and that you could have hundreds, thousands, or even millions of those a day, that you don't make millions of journal entries for each one. You make, you know, you total them all up and then put them in as one at the end of the day. The information is still there. You just have to go back to whatever the sales journal or the accounts receivable subsidiary ledger. You know, you can look at the details in those, but they are not going to be in the general ledger that has everything for the entire company. You know, if you look at Walmart's financial statements, and you know, you buy something at Walmart, if you look at their financial statements, your sale is in there somewhere. You know, your sale, whatever it is, in there, but they don't list it separately. They have record of it. You know, you can go back and say, okay, I bought this, and I want to return it or whatever. But they're going to have a sales journal that handles all that. It's not going to go through their big general ledger. Okay. And we're down to E. I know my spacing is going to be way different. It's going to be way off. So E. Sales and accounts receivable cutoff. And this is really two different cutoffs. The sales cutoff is usually done by shipping documents. You know, only those things that are shipped are sales. If it's not shipped, it's not a sale. Accounts receivable is usually done. Well, the accounts receivable and the sales will go to the actual increases, you know, additions to the accounts receivable will be done up here. So when you do a sales cutoff for the additions, it'll also be the accounts receivable cutoff. But accounts receivable, the accounts receivable collections cutoff, I should say cutoff. So only those things that are on the checklist and the bank deposits at year end or at month end. You know, only those things that go into the bank before the end of the period are considered to be accounts receivable collection. So the cutoff for that would be those checks that are put in by, say, December 31st. You know, if your client gets checks in January that are dated December, it doesn't matter. You know, it's when you actually put them in the bank that they're actually counted as cash. So it doesn't matter what the date is on the check. It's when they are deposited that you're looking at this. Ooh, don't do that. Question on that? Bill and hold criteria. This is one of those things that is very difficult to book as a sale. Bill and hold. Bill and hold is when you say, okay, well, instead of shipping it out, I'll bill them and I will hold it and not send it out to them. You know, we'll mark it sold and stick it in the corner. This is not allowed. The general rule, no. There is a few situations that it's possible that it could happen, and that is if there's a guaranteed contract, if it's done at the convenience of the customer. So it's not the convenience of the customer. So this has to be the customer's idea. And it could be the customer says, okay, wait, don't, we ordered a machine, don't send that machine yet. We're still trying to get the old one out and we can't put the new one in until we get the old one out. So don't send it to us. And the charges are going to be paid regardless of the delivery. So that, they're going to pay for it either way. And again, this is a very rare occurrence, and 99.999% of the time it's not allowed. However, there are very kind of rigid criteria that must be met before it can be agreed to. But you get people to say, we'll just mark them sold and put it in the corner. Well, we're not going to sell it again. We're just going to mark it sold and put it over there. That's not a sale. It's not a sale until it leaves the place. Okay. Pledging of accounts receivable. Pledging of accounts receivable may impact the client's rights to the asset. So if those accounts receivable are pledged either as collateral, or they could even be sold. The rights and obligations are could be affected, in that you can't put it on the books if you don't actually have the rights to those accounts receivable. The bank may be holding those accounts receivable for payment of a loan or something like that. And in that case, it could be possible that those are not going to be really the clients until that loan is paid. Or something. The bank's not going to let you sell out the collateral, collect the collateral from underneath them. Any payments that are made will go to the bank. Okay, confirmations, and these are important. These are confirmation, so these are sent to this is very important. These are sent to the client's customers. I'm sure there's a better way to write this. Essentially, the client's customers who have accounts receivables with the client. In other words, they owe money to your client. So IBM, let's say you're auditing IBM. IBM has customers and those customers owe them money, right? So the customers have accounts receivable. So now you're worried that IBM or whoever your client is simply adding accounts receivable onto the books to boost up revenues, with fictitious sales. You're afraid that they're doing this. No, not that. This. Yeah. You'll notice that an unscrupulous client could say, okay, well, we made this sale. Now notice there's no cash involved here. They could just make this up. How do you know that this is a real customer? They could just be making this up, putting it on the books. So for that, we send confirmations to the customers of our client. So our client's IBM. IBM has customers all over the world. We may pick a handful of those customers and send them a confirmation saying, hey, do you owe this amount to IBM? And they'll respond whether they do or don't. So these are confirmations sent to customers. Now you say, why do that? Well, you do that because their customers are third parties. It's somebody outside the company. They may have a sales order and all this other stuff to go with it. However, those documents are all generated inside the company. And so, you have to determine whether those are actually real customers or not, and anything was actually sent to them. So that's what the whole sales confirmation thing's about. Right with that. Okay, positive confirmations. And there's examples of these, I'll show you later. Positive confirmations. You know, there's a better way to say this. Oops. This is a better way of saying it. All positive confirmations must be returned. Okay, so all positive confirmations must be returned. So if you send out the confirmation, and I'll show you an example of it in a second here. If you show the confirmation is positive one, it must be returned. Negative ones, negative confirmations are only returned if the amount is disputed. It's got a long way down. All right, so the positive confirmation, all of them get returned. Negative ones are this. Negative ones say, okay, you know, which ones are you interested in? Well, the only ones you're really interested in are the negative ones. The ones that say, no, this isn't right. This isn't what I owe. And so then, you know, those are the ones you're interested in. So it's not uncommon to use those accounts. Now, the negative ones, well, yeah, let me show you what they look like, and then we'll talk about the pluses and minuses of them. So here is a positive confirmation example. It will be done on the client's letterhead. You know, you send it out, it'll say it's from IBM. So you have IBM's letterhead out there. Why? Well, because you don't have an account. You know, whoever this is doesn't owe you any money. You don't want to put the CPA firm. They don't know who you are probably, and they say, well, I don't owe you any money, right? But if it's IBM, they go, oh yeah, we owe IBM X amount of dollars. So you're going to put on the client's letterhead. So if it's IBM, IBM. If you're Ford, it'll be Ford, whatever. And usually you do this by invoice, and they'll say, you know, do you owe these invoices? And they'll say yes or no. If they say yes, everything's okay. If they say no, you say, okay, well, okay, if it's not correct, then please explain below. And you're going to ask them to, you know, say, okay, well, what's wrong with this up here? They say, well, we returned part of this or whatever it is. So this is a positive one, and then they'll say, please return this confirmation in the self-addressed envelope to, you get it returned directly to the CPA firm. It does not go to the client, does not go back to IBM. It goes right to the CPA firm. And this is good because it's a third party. So they're probably documented itself by the CPA firm. So this is the best evidence. It's a third party, presumably they're unbiased. And the client doesn't have any chance of getting it and altering it because it's sent directly back to the CPA firm. So this is a way of taking evidence that is not very good. This evidence that everything is made up by the client and moving it up. Say, okay, this is the client's documents, client generated them, blah, blah, blah. No good, not no good, but not very, you're more skeptical of it, we'll put it that way. Whereas down here, it's a third party coming from a customer and it never goes to the client. So if you're auditing IBM, IBM never sees this. And whatever they have written in here, you'll figure out what to do with it. So this is a positive confirmation. Negative confirmation. It's similar. Okay, you get this invoice, is the amount indicated above correct, yes or no? And notice this. If the amount indicated above is correct, please disregard this confirmation letter. If it's not correct, then you send it in. So only if it is not correct does it get sent back. If it's not correct, then you send it to us. If it is correct, if you answer this, then you throw it in the garbage. So you send out the negative confirmations. All right. Let's think about these negative confirmations though. What is a drawback of these negative confirmations?
They rely on the customer to actually turn it in, otherwise you're going to assume that it's correct.
Yeah, and notice that there could be problems with that. Maybe you mail it to the wrong address. You mail it to the wrong address, they never get it, it doesn't come back. You assume that everything's okay. Or like what you're saying too is, suppose the client gets it, what? No, we don't know. There's a bunch of idiots, scribbles it up and throws it in the garbage. Both of those, you really can't make too much of it's not very much evidence for the ones that you don't get back. You really can't make any conclusion about those that you don't get back because you don't know if it made it to them. You don't know if they read it. You don't know if they agree with it or not. They may just throw it in the garbage, So negative confirmations are not as good. Positive confirmation, if they throw it in the garbage, you call them up. Did you get that? Yeah. Did you fill it out? No. Okay, well, I'll send you another one. Okay. So you send out 100 of them, you get 87 back. You make the phone calls, now you get 96 back. Another round of phone calls, and you get a couple, and then you get down to the last couple ones, and you go, okay, well, I'm going to fax it over to you. What's your fax number? And then fill it out, and then fax it back to me, and I'll be waiting by the fax machine for it to come back. So the positive confirmation ones are kind of a hassle, but they're better evidence. So looking at these two, you go, okay, well, which one should we use? Well, there's a couple things that are going on here. There are a couple ways that you usually When do you use which one? Okay. There's the cost factor. Positive confirmations cost more. Okay, so let's take a look here. So if so let's say that you have positive confirmations. Let's say that you need 100 of these to be comfortable with your testing. Now, the positive confirmations are the better ones. You know, these are more valuable because you're actually going to hunt down each one of these. It's going to cost more, but you're going to hunt down each one of these. Now, negative confirmations. If you're going to be just as comfortable using the negative confirmations, are you going to have more than 100 or less than 100? So 100 is the best evidence. Negative confirmations, not as good.
You need more of them.
Yeah, so let's say you need 500 of these. Okay, let's say the cost for positive ones was 20. And the cost for the negative ones is 3. You know, the question is, which one would you use? If you're just as happy, you know, with 100 positive ones or 500 negative ones. So the total cost for the positive would be 2,000. Oops, that's not. Okay, 2,000. Oh, that's not right. And the cost for the negative ones, 100. Oops, one more 0. So in this case, you're looking at just simply at the cost of them. You know, it'd be reasonable to say, okay, we're just going to do the negative ones. We're going to be just as happy, and it'll cost less. So, you know, there is this idea that you don't always take the best evidence. Why? It might be too expensive. So there's a cost factor. Now, usually the breakout is this. Positive confirmations are for few accounts, high dollar amounts. So these are usually when we use these accounts. So it's few accounts, high dollar amounts. And negative ones are kind of just the opposite. Let me do this differently. So usually use the negative confirmations for many accounts, low dollar amounts. The negative ones are for many accounts with low dollar amounts. And here's why. If they're for low dollar amounts, let me go back. Let's do this one first. Positive confirmation. high dollar amounts. Any one of these accounts might be material, right? If you have 10 accounts and they're all worth $500,000, let's confirm all of them, right? So generally a few accounts with high dollar amounts. Negative confirmation, many accounts with low dollar amounts, even if you miss a few of them, they're probably not going to be material. Second here. Okay. So positive confirmations, few accounts, high dollar amounts. Many accounts, low dollar amounts. Okay, let's go down here. Just did that. I think I've already put this out there. Accounts receivable, miscellaneous stuff, relevant assertions, blah, blah, blah. You've seen this before. Let's go down here to these questions. These are underneath the accounts receivable, miscellaneous stuff. I can't remember if that's a book heading or if I just put that out there. These are the relevant assertions. Okay, which of the assertions is aided by the accounts receivable confirmation? This one is actually kind of a difficult one. So, by the way, some of these are maybe better than the other. Which ones do you think that this is probably going to be the most? I'll tell you, it's probably not as obvious as you might think. But which one of those is of these assertions?
B?
Which one?
B,
B is,
existence or occurrence.
yep. Excellent. Yeah, it tells us the existence or occurrence, that these exist. They don't necessarily, some people say, well, wait, isn't that completeness? Or the value of it, doesn't it say anything to those? Especially this valuation. Well, it doesn't tell you the value of it because you go through here and they're going to write down anything that is wrong. Well, here's the problem with that. There's a couple of problems with it. First of all, if you're talking about getting the the valuation of it, notice there's something going on here that, let's say that these 3 invoices are not all the invoices. Maybe there's a 4th invoice. Now, you might have a really honest customer that says, oh no, we owe you more money. But it's also in the realm of possibilities that they say, hey, there's an invoice for $13,000 that they're not showing here, and I'm not going to say anything because hopefully they'll forget about it. But anyway, so it is possible that the customer does not, the customer of the client is not completely honest if these are being understated. It's also possible that even though the customer says, yeah, these are correct, yes, I do owe $36,000, they may not be able to pay. Yeah, I owe $36,000, but guess what? I'm going to go here in bankruptcy next week, and you're not going to see a dime of it. So even though you get it back and they say, oh, look at that, you get a positive confirmation, you get it back, oh, they say this is correct. Well, that doesn't necessarily mean that that's the value of it, because you may not see any of it, depending on their financial condition. So it's not really good at getting a value. What it does tell you, though, is that it exists. That these are real customers and that they exist, not necessarily that the dollar amounts are correct. And especially for the negative confirmations, it's very difficult. You basically look, I'll tell you what you look for, especially with the negative confirmations. What you look for is a pattern when you get these back. So if you get back the same, and you get all these, you get whatever, 16 of these back, And if 13 of them say, that the shipping charges were overstated, that kind of sends you in the right direction, going, okay, wait, there may be a problem with the shipping, right? So you look into it further. So a lot of times it isn't necessarily that these give you the correct value for something, but it might certainly tell you where to look that there might be problems. So if you get a number of them come back with the same problem, you might decide to, okay, we better look more there. Okay, which, I think you guys are all going to get this one. Which assertions are aided by the cutoff procedures?
D.
Yeah. Yeah. Yeah, community cutoff. Cutoff is kind of a new one. This is added into it. You could also say that it has to do with evaluation of it and that they're getting everything in the correct period. Yeah, so it could be existence and completeness, and that could be there too. Which sales and accounts receivable assertions are aided by analyzing the bank cutoff statement? Maybe the same one, maybe same as the other one. Okay, we're gonna do these 4, 5, and 6, and then we'll be done. And these are not very difficult. Are accounts receivable confirmations required by generally accepted auditing standards? Yes. Yes, unless you have a really good reasons for not doing it. They say, well, what's a really good reason? Well, it depends on the accounts receivable itself. For instance, when I was at, I think I already told you guys this, but hey, I bored you for 2 hours. What's another minute? When I worked at Navistar, we had an engine plant in Indianapolis, Indiana, and something like 95% of our engines were sold to Ford. So our accounts receivable were really basically Ford. At that point, it really doesn't make too much sense to do accounts receivable confirmations because the very bulk of our business is actually one customer. So focusing on that one customer is probably more I don't know, rational than sending out a bunch of confirmations to customers that maybe buy a couple engines a year or a handful of whatever, when a huge portion of our sales were to one customer. Okay, are confirmations required by the international standards? No. The international standards are a little bit more, they allow a little bit more for professional judgment. So US standards, generally, you have to send out confirmations unless you have a good reason why, basically. The international standards, they don't tell you what to do. So you can do it, if you want to do it some way different, you say, well, how else could you do it? Well, you could do it from shipping documents. Look at the bills of lading. Don't send these out. Just look at the bill of lading, see what they sent out on the bill of lading. The backtrack through the pricing and the invoice and all that, and see what the amount is. So you can do it through shipping documents. You can verify what was sent to different customers and that sort of thing. So international standards are, and you'll find this in general, they allow a little bit more for judgment. Whereas US standards are must do this, can't do that, that sort of thing. I'm not sure why. I think it's just our legal system or something. We generally tend to, really, be specific. So accounts receivable are required by a US standard, yes. Again, unless you have a really good reason. Or any international standards, no. Okay, who should write off? I think I may have already talked about this. Who's authorized to write off accounts receivable? It's the same thing as for credit authorization, but anyone except the sales department, or the accounts receivable people. So whoever, actually, the accounts receivable clerk, let's say. So who can write it off? That's not how you spell clerk. Anyone except the sales department or the accounts receivable clerk. So someone outside of sales, someone like outside of the accounts receivable, and it should be obvious why. You don't want someone writing off an account and making more sales to that person. So the sales department is not a good one for it. And accounts receivable, you could also have the same thing, and that you don't want someone who's involved with the record keeping to have the authority to write off an account also. So, record keeping and authorization, you want to keep those separate, and they could write off accounts, for friends or whatever else, so you don't want to do that. And we will stop here. And I think I have, let me check and make sure I'm not lying to you. I think I have included the assignment for Anthony. Yeah, the Anthony handout is already up. And I apologize for last week not putting stuff up there. But yeah, so Anthony's stuff is up, and we're still working on this one, so that'll be it. So this week, the only thing we have to turn in is this. This will be due, I think it's due on the 15th. Any questions? Okay, I know this. I know this chapter is a little bit dry, but not all what's coming could be, fun games. All right, so I will talk to you guys next week. We'll finish up this accounts receivable handout, and we are getting down to it. What is this, week 12? This week 12. So we only have 3 more weeks after this. But anyway, so next week we'll finish up the accounts receivable, and we'll probably end up doing inventory and then wrapping up the audit. And that'll be it for the semester. Okay, any questions? Okay.
Thank you, Professor.
Thanks, guys. Talk to you later.
Thank you.
Oops, I'm on the wrong thing here.